Good morning, everyone, and afternoon, almost. Good morning still. And thanks for having me. Thanks to Christoph. And thank you to you guys for being here today. So just brief introduction. So Neil did a good job there. He's really hyped me up. But we do have a family business. It is 81 years old, and it's in the textile space, not in the mafia space. And we... it's actually one of the things I'm most proud of, actually. My grandfather is still in the business. He's 92 years old, and I get to drive with him on a daily basis into work and listen to some of his stories. The business is very old school, and we are trying to innovate and adapt, and we've been doing these pivots. But separately, I've taken several sabbaticals from that. So I've been in the investment space, I've worked in the asset management space, I've been locally in South Africa in the asset management space, in Dubai in the asset management space. I've got a fellow IE Business School alumni, and I was in Spain for a year and a half. My career's done this. It's not been a straight line. So often you read up on people, and particularly entrepreneurs, and it seems like one straight line. It wasn't for me. And I've been an entrepreneur. I still am an entrepreneur. I am an investor. So I see things from a few different perspectives. Today, I'm going to be talking about trying to solve the early stage investor challenge that we've got. And click is here. So before I get into it, just quickly to contextualize, I'm not going to get into the solutions up front. I just want to maybe explore some questions, maybe get us all up to speed on some of the base interpretation of what I'm going to be talking about. And also just to give you a sneak peek, the way I'm looking at this really is from a macro perspective, not a micro perspective. So how do we solve it for the industry? So I'm not going to be talking about things like matchmaking platforms where we're using smart machine learning and artificial intelligence to swipe left and swipe right. I tried that, 2013, didn't work. We're going to be talking about some of the macro solutions that I think we can potentially implement. All right, so this is the journey of a startup, the journey that most of you are on. That's your blue line. This bottom section here is called the Valley of Death. And when I got started in 2012, 2013 in the startup space, the line was a lot deeper. The Valley of Death was a lot bigger. I got to know a lot of good entrepreneurs that unfortunately didn't make it. And my mission in life since then has been to try and shift this line upwards. Through your journey as a founder, you're going to get support from different people at different phases in your life. This is just the financial support. So typically you start off by bootstrapping, you may tap into incubator money, but your first real professional investor is normally an angel investor. And what we've seen with angel investing globally is that there's been a migration from where you see them now slightly further down that curve. The reason being is that angel investors are also expecting startups to adopt lean startups. So lean startup changed the industry when it was initially introduced. Steve Blank, Eric Ries, many years ago. And now there's, even in the US, a lot of us have heard of stories of these Stanford kids who stand up on stage and who pitch their ideas, and after the stage, everyone's rushing up to them to write checks. That's not happening anymore because of lean startup. There is this expectation that you at least go and engage with your customers, get some feedback from your customers before we look to fund you. So angel investors, venture capitalists, and then banks. But banks typically are not going to touch you up until you've reached 3 years of audited financials, you've got some traction. They aren't your first, they're usually the first people that come to mind, but they're usually the last people to fund you. So let's do a deep dive into what angel investing is all about. So it is early stage investing, equity based, and we use our own money to invest in your companies with the idea of developing over time a portfolio. And the reason we look at or approach our investment from a portfolio perspective is we understand that a lot of these companies are unfortunately going to fail. And through portfolio diversification, we're able to mitigate that risk to some extent. So there are a lot of American angels who've got portfolios in excess of 150 companies. In South Africa, I think there are only a handful that have double-digit portfolios. So we're still very nascent when it comes to our early-stage angel investment market. And then we bring three things to the table. So often the starting point of your conversation with any angel is the money. It's the capital. I know I need X. How much will you give me? And what does that translate into equity? But actually, there are two other things we bring to the table, so knowledge and networks. And those two things, in the long term, are actually of more value than the capital. So my advice to all entrepreneurs, to all founders, is to go and do reverse due diligence. Go and understand who the people are that are going to be investing in your business before actually getting into that transaction. Make sure that they can add value from a non-financial perspective to your business. And how does this differ from venture capital investment then? So I think the first thing we need to know is that venture capital investors are money managers. They are managing money on behalf of other people, whether that be individuals or institutional investors. Angels are investing their own money, typically. Venture capitalists establish a mandate and they go and raise capital on the back of that mandate. We have a preference, and that preference usually comes from our professional background. And then VCs are registered and licensed, whereas angels are not, at least in this market. So that's a pro and a con, and this is why it's important for you to do your reverse due diligence. There are lots of people calling themselves angels in this market, but they come from, let's say, a distressed asset background, right? And their approach to angel investment is, I like Christoph, he's doing great things, but I'll give him some rope to go and hang himself. And when the oxygen's almost gone, I'm going to jump in and take 70% of his business. I've heard this, and we've had to exit people from our angel network because of their approach to angel investment. And portfolio theory. So you've been hearing from some VCs earlier, and you'll hear from some more later, but they are governed by portfolio theory. So the logic goes that you can only take exposure to a certain number of companies. There are two reasons for that. Number one is your fund typically has a term to it, 10-year term. And number two, your post-investment management process is resource intensive. There's only so many companies you can help and manage. Whereas angels, I mentioned this earlier, try and take exposure to as many companies over time as possible. All right, so there are also some common things. So we are both innovation investors. We are looking for the next big thing. We just invest slightly earlier than what a venture capitalist would. We're both equity investors. So we would typically invest preferably through a pure equity deal, but where we can't come to an agreement, and you guys probably know this, it's a lot of back and forth on this valuation question. Where we can't come to agreement on a valuation, we do convertible notes. But that's equity linked. And then we de-risk, venture capitalists de-risk their investment by being actively involved from a strategic perspective, not operationally, but strategically involved in your business. And then typically we ask for certain control measures. So whether that be a seat on the board, whether that be line of sight to the bank account, regular catch-ups, there's some sort of control element and that works both ways. So those are the forums where you can leverage the knowledge and the networks that I spoke about earlier, but also it's often where we engage and get an update on your business and where we can help you. All right, so next question is, what does the landscape currently look like? These are SAVCA numbers, and what you can see is we've got a big problem on the my far right, your left. lack of angel investment, right? And this is total rands invested across the 2019 calendar year. Angel investment makes up a very small portion of investment, yeah? 5.7%. Similarly, if you look at those transactions slightly differently, seed makes up 3.7%. So both very small. And if we then superimpose that on your journey as a founder, angels are making 5% of investments, seed, you're getting 3% of total funding. There's a real problem in our ecosystem. And I like visualizing that through supply demand, right? So if there was a natural equilibrium for supply and demand, it would look something like this. What it's currently looking like is this, where there's a big shift in supply of capital in the early stage. And as a result, the throughput to the venture capitalist is suffering. So venture capitalists are reliant on upstream activity for deal flow. And unfortunately, it's any functional ecosystem, any developed ecosystem needs the previous chain or the previous activity in that chain to perform. And so what you're seeing there is the real demand for VC. And what I mean by real demand is investment-ready demand. There's a lack of investment-ready demand for capital in the VC space, primarily because the upstream activity is unfortunately nascent and needs development. And so when I picture it really as this upside-down pyramid, and that base of the pyramid is narrow. And it's almost like we're trying to run a marathon on our toes. That's the way this ecosystem is operating. Okay, so what should the landscape look like? And I've gone and just done some research on the continent, or picked up some research on the continent, and this comes from Partech Ventures. Partech's got a slightly broader definition of African startups. Their definition also includes any international startup, so a startup sitting in Paris that's servicing Africa as its primary market. And what you can see is a much healthier cross-section there of investment, 2.5 to 1 almost in terms of investment in seed to Series A. Similar numbers in terms of total investment that was made. So this is Pan-African. Pan-Asian is a similar story. It's almost a 1-to-1 story, whether it's looking at 2013 or even the 2020 numbers. This is what it can look like for us as an ecosystem locally. So how do we get there? So I think to answer that question, we need to find out where is the money? Where is the money currently? So I've used two proxies to answer that question. This is PIC, Public Investment Corporation, and this is their asset allocation. There are 4 numbers to highlight there. So there's listed equities, bonds, and then cash, and the small number there is private equity. So surely we can convince the PIC to make more private equity investments. Second proxy is private capital. So that was public capital, private capital. This is ASISA, and this is the Association for Savings and Investments. And this is their asset allocation. And look at the cash number. 19% of consumer money, of private capital, is sitting in cash, earning very little. Okay, so let's jump into those solutions. Number 1, I think we need to create our own stories. We need more exits. We need to create our own momentum, right? And we are already starting to see this flow into the ecosystem. So just the ones more recently, Standard Bank bought into TradeSafe, an American company bought out Luno, Pick n Pay bought Bottles. I believe the founder of Bottles was here yesterday. Mr. Price purchased Yappy Chef. I think more of this is going to help our ecosystem, and that's actually where Cape Town got its early momentum from, right? Cape Town had a few big exits. It was Shuttleworth, it was Vinnie Lingham. Peter de Villiers to some extent, and they created what we now know as the Cape Town ecosystem. My mission is this: to educate and to reduce the friction to investment, right? So I'm trying to convert this to this as Jozi Angels. And we do that really through educating people on what angel investment is all about, forming syndicates, getting experienced investors in those syndicates to mentor the new angels that are looking to get into the space. And if I can do my pitch to you guys, if you are aware of anyone who's making investments into property, who's making investments into listed equity, tell them to look at this space. Tell them to look at the innovation economy. And they're welcome to reach out to Jozi Angels and start and form part of our syndicates. The minimum investment is 50,000, so the hurdle rate is not as high as you'd expect. And we do handhold people through the process. What we've seen in other markets is tax incentives, and I've taken different tax incentives in different markets just to give you an example of what is possible. And I know the Startup Act, the local Startup Act, is being lobbied for locally. Matsi was here yesterday. I don't know if she spoke about it, but this is what's happening elsewhere. So there are income tax benefits. There are capital gains tax benefits. There's grants that are given back. All these other markets have identified the innovation economy as the potential for their future. I think we as a country need to do the same. And so this is very wordy, and I'm going to try to simplify this. This was actually some friends of mine, investment bankers, and I spitballing. So I reached out, canvassed a few friends, and I said, how would you solve this challenge for us? And I'm going to try to simplify what was said. So take two personas. Number one is an angel investor. Number two, a listed company. For an angel investor, his or her cost of capital is almost zero, right? There's no one to repay. There's no equity that I've gone and raised. There's no debt that I've got. My cost of capital is zero, and therefore my propensity for risk is higher. The listed equity, the listed company, they've gone and listed on the stock exchange. They've got shareholders. They've got a dividend policy. They presumably have debt, maybe on a fixed and floating basis. But there's a whole lot of complexity that's worked into their equation around cost of capital. And as a result, their propensity for risk is lower. So if we can reduce interest rates and potentially the risk-free rate in some way, we can reduce the cost of capital and as a result get people assuming and adopting more risk. And then the last one, I'm almost finished, Katie. Last one is attracting foreign capital. So this is Nigeria, and that's a big, big number. So 71% of their early stage capital is offshore capital coming in. How? Why? So I think the first thing is they've got a big diaspora, big Nigerian population living elsewhere, and they've been extremely supportive of the local ecosystem. Lagos Business Angel Network is run by people who are sitting in the UK. They've got people locally as well, but was started by a guy called Tommy Davies, who sits in the UK, and he's been canvassing people to look at the Nigerian economy as an investment destination. They've also got a big population. So 300 plus million people, we've got 60 million people. Big populations tend to lend themselves to tech solutions or the success of tech solutions. So whether it is Nigeria or Egypt, they've seen a lot of foreign capital coming into their markets, all big populations, right? But I think there are things so those are things we can't really change, diaspora, big population, but there are things we can change. And I spoke about the tax incentives. The other thing that we spoke about on Monday on Christoph's channel is the question of intellectual property and being able to offshore your intellectual property a lot easier. So as you're going through your development as a startup, you saw that line earlier. As you're scaling, you want to target other markets. And to do that, you need to potentially offshore your IP. And right now, that's a hugely cumbersome and can be an expensive process. But then we can also be focusing on what I call our USP as South Africa, as a nation. So for me, two things. Business to business. I think we've got a strong business infrastructure, and most of the companies that I've seen that have been successful in this market have all been B2B solutions. Yeah? And then we've also got a very strong financial sector and infrastructure there. I think if we can leverage those two USPs, we'll carve out a niche for ourselves on the continent. So just to recap, number one, create our own stories and create our own momentum through acquisitions and exits. Number two, if we can educate investors and reduce friction to investments. Number three, create tax incentives and offer additional government support. Number four, reduce the cost of capital. And the last one there is attract foreign capital. So I believe we're transitioning straight into the panel discussion. I'll take questions on what I've put forward here in the panel. Yeah? Thank you.
Thank you.